A 3-year lock-in period recently expired for Yes Bank shares. The stock witnessed wild swings that day, but has stabilized since then. The lock-in period for Yes Bank, where investors were not permitted to redeem or cash out of their investments, was part of a bailout plan chalked out by the Reserve Bank of India and the Securities and Exchange Board of India. Though typically a lock-in period in the stock markets is used for new share offerings, they are also applicable across various financial instruments like mutual funds, insurance policies, and bank deposits. So what does a lock-in period for initial public offering mean, and why is it enforced? A lock-in period acts as a temporary restriction on the sale or transfer of shares after an IPO. This is meant to prevent company insiders, including promoters, employees, and other stakeholders like anchor or pre-IPO investors, from selling their holdings immediately after the stock's listing. The idea is to provide stability and security to the share price, which may otherwise grapple with severe volatility in the early stages of public trading. This also allows the company to establish itself in the market and gain the confidence of long-term investors. The length of a lock-in period post an IPO varies for different sets of stakeholders. For instance, 50% of the portion allocated to anchor investors, which constitute marquee institutional investors, is required to be locked in for 30 days, while the other half has a lock-in period of 90 days. In the case of promoters, the lock-in window post an IPO varies between 6 months and 3 years, depending on certain conditions. Once the lock-in period or selling freeze expires, investors are allowed to exit the shares. In most cases, selling by large investors following the lock-in expiry weakens the stock price in the market as its supply increases. At the same time, the market sentiment towards the stock also turns relatively bearish due to major investors dumping the shares instead of holding them. Hence, lock-in period expiry is often seen as a test of the investor sentiment for a given company. For instance, shares of new age IPOs like Paytm, Nykaa, and Zomato, among others, which were already beaten down last year on recession and valuation worries, succumbed to even more pressure towards the year's end. This is because several large investors exited these stocks post the expiry of their lock-in periods. Hence, retail investors are often vulnerable as they can only grasp institutional investors' assessment of a company's long-term growth prospects after the lock-in period ends. Large institutional exits following lock-in expiry often make small investors lose confidence in the stock. After the lock-in period expires, an investor who is optimistic on the company can buy more shares amid weakness triggered by large selling.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.